I'm Tim Craighead, Senior European Equity Strategist for Bloomberg Intelligence, and I want to talk you through why we think UK cyclicals are better positioned than defensives in 2022. Let's start with a bit of background. Now, this chart you can see in the top panel, relative performance between cyclicals and defensives, the white line, tends to follow relative earnings trends, the blue line. But the pair stalled out in 2021 largely because cyclical valuations fell dramatically. The market just simply didn't believe that earnings would be sustainable. However, we think that the earnings advantage will remain with economically sensitive companies through at least the first half of this year and maybe throughout the year. And we think the market's going to come around to our view. Now, here's why. Let's first look at drivers. Integrated oils, financials, and mining are about 70% of the UK cyclical segment. And this is highly unusual, like nowhere else in Europe or the US. And these groups tend to track interest rates, oil prices, and industrial metal prices, all of which are moving up with the global economic expansion. Now, in contrast, defensives, we think, may be at some risk to rising costs, and generally they've got less top-line leverage to underlying economic activity. Now, if we take this and put it into the earnings outlook, here we see something that contrasts quite significantly with the underlying drivers. Consensus earnings estimates for 2022 and 23 appear to be conservative on cyclicals, showing small declines for both years, while they're relatively optimistic on defensives, showing robust growth, and a lot of this is driven by increasing margins. We think that this view is likely to shift in coming months, which would continue a pattern of positive revisions for cyclicals, modest negative revisions potentially for defensives. Now, let's shift to valuation. This can give you a really good bead on what the sense of market sentiment is. And currently, all the larger banks, oils, and miners are trading at forward earnings multiples that are below 10-year averages. And this suggests the market's skeptical that 2021's earnings rebounds are going to be sustained. However, if we do see positive surprises that we expect, sentiment may improve. I'd mention as well that for some broader context, this pro-cyclical UK view that we have is part of a broader theme that we have across Europe, where both our sector and country scorecards tend to favor cyclicals versus defensives. And lastly, I'd be remiss if we didn't mention risks, because certainly there are some to consider, but we think they're largely manageable. Omicron infections are high and they're worrisome. But the impact on healthcare systems so far have been relatively muted, and life is moving back towards a new normal. Interest rates, yes, they're rising and rising rapidly. But if you take a step back and look at a longer term period, they're still near historical lows. And importantly, we don't think that central banks are really looking to break economic activity hard. We think that they're really looking to remove what have been super accommodative policies, and that's different. And lastly, margins are very high, but a lot of the reason why is because of pandemic-related restructuring initiatives, and these are proving to be relatively long-lasting. We also think that supply constraints that have been boosting costs are probably going to ease as we go through the course of 2022. So let me bring things to an end here. For more insights, and there are a lot more on this theme, please send me a message or give me a ring. And don't forget, come to our strategy dashboards on the Bloomberg terminal, BI Stocks and BI Asset. Thanks a lot.